China's fake Starbucks, the Luckin Coffee fraud. In the bustling streets of Beijing and Shanghai, where centuries-old tea culture meets modern coffee cravings, a homegrown challenger emerged to take on the global coffee giant Starbucks. Luckin Coffee burst onto the scene in 2017 with a bold promise to become China's largest coffee chain within 5 years and dethrone the Seattle-based behemoth that had dominated Chinese coffee culture for 2 decades. With sleek blue and white storefronts, aggressive pricing, and a mobile-first approach that seemed perfectly tailored to Chinese consumer preferences, Luckin appeared to be the David ready to slay Goliath. The company's meteoric rise was nothing short of extraordinary, opening thousands of locations across China at breakneck speed and attracting billions in investment from eager venture capitalists and public market investors alike. By 2019, Luckin had achieved the impossible, claiming more retail locations in China than Starbucks itself, a feat that sent shockwaves through the global coffee industry. But beneath this remarkable success story lay a web of deception so sophisticated and brazen that it would ultimately expose one of the largest accounting frauds in modern Chinese corporate history, fabricating over $310 million in sales and betraying the trust of investors worldwide. The masterminds behind this elaborate scheme were far from amateur fraudsters. Jenny Jiaqian, Luckin's chief operating officer, and Jian Liu, the company's chief marketing officer, orchestrated a fraud that would make even seasoned white-collar criminals take notice. Qian, a Harvard MBA graduate with years of experience at prestigious consulting firms, understood exactly how to manipulate financial statements to create the illusion of explosive growth. Liu, meanwhile, brought deep expertise in digital marketing and customer acquisition, skills that proved invaluable in creating fake transactions that appeared authentic to auditors and investors. Together, they constructed a financial house of cards that relied on fabricated sales data, inflated customer numbers, and fictitious marketing partnerships. The fraud wasn't limited to a few rogue employees. Internal investigations later revealed that the scheme involved dozens of Luckin staff members across multiple departments, from regional managers who reported false store performance metrics to accounting personnel who manipulated revenue recognition procedures. Perhaps most shocking was the discovery that these fraudulent activities weren't a desperate last resort measure to save a failing company, but rather a calculated strategy implemented from the very early stages of Luckin's operations, suggesting that the company's entire growth narrative was built on a foundation of lies. Luckin's fraudulent empire was constructed through a sophisticated network of fabricated transactions that would have impressed even the most creative Hollywood screenwriters. The company created an elaborate system of fake orders using multiple layers of deception that initially fooled auditors, investors, and regulators. Employees were instructed to place thousands of phantom orders through the company's mobile app using corporate credit cards to purchase coffee that was never actually prepared or delivered. These fake transactions were then recorded as legitimate sales in Luckin's financial statements, inflating revenue figures that would later be reported to investors and the Securities and Exchange Commission. To make these fabricated sales appear more realistic, conspirators went to extraordinary lengths, creating fake customer profiles complete with detailed purchase histories and realistic consumption patterns that mimicked genuine user behavior. The fraud extended beyond simple sales inflation to include fictitious marketing expenses and supplier relationships designed to justify the company's rapid expansion and massive cash burn rate. Internal company communications, later revealed by investigators, showed employees discussing specific quotas for fake transactions, with regional managers competing to see who could generate the most convincing fraudulent sales data. The scheme became so institutionalized within Luckin's operations that new employees were routinely trained on how to create fake orders as part of their standard onboarding process, treating massive securities fraud as just another aspect of their daily responsibilities. The financial engineering behind Luckin's fraud was as impressive as it was criminal, involving complex manipulations of multiple revenue streams and expense categories that created a convincing illusion of sustainable business growth. Company insiders inflated not just direct coffee sales, but also revenue from food items, merchandise, and partnership deals with other brands, creating a diversified fraud portfolio that made the deception more difficult to detect. Luckin reported that its average store generated significantly higher revenue per square foot than comparable Starbucks locations, a claim that should have raised red flags but was initially accepted by investors eager to capitalize on China's growing coffee market. The company's fraudulent financial statements showed gross margins that improved dramatically over time, suggesting operational efficiencies that were actually impossible given Luckin's aggressive pricing strategy and high real estate costs in premium Chinese shopping districts. To support these inflated revenue figures, conspirators also fabricated customer acquisition costs and marketing expenditures, claiming to spend hundreds of millions on advertising campaigns that either never existed or were vastly smaller than reported. The fraud extended to inventory management, with stores reporting coffee bean and supply purchases that far exceeded what would be needed for their actual sales volumes, creating discrepancies that required additional layers of deception to conceal. Financial records later analyzed by forensic accountants revealed that Luckin's reported same-store sales growth, a key metric for retail investors, was almost entirely fabricated, with real growth rates potentially negative during several quarters when the company claimed to be experiencing explosive expansion. Luckin's path to public markets was paved with fraudulent financial statements that told a compelling but entirely false story of a disruptive Chinese startup ready to revolutionize the global coffee industry. The company's initial public offering on Nasdaq in May 2019 raised $561 million from international investors, with share prices initially soaring on the promise of capturing China's massive and growing coffee market. Luckin's prospectus painted a picture of a technology-driven coffee company that had cracked the code on Chinese consumer preferences, combining mobile ordering, competitive pricing, and strategic store locations to create an unbeatable business model. The company claimed to serve over 12 million customers through more than 2,800 retail locations, numbers that were significantly inflated through the systematic fraud that had become central to its operations. Investment banks Goldman Sachs, Credit Suisse, and Morgan Stanley led the IPO process, conducting due diligence that failed to detect the sophisticated fraud scheme that had been operating for years. The offering documents highlighted Luckin's impressive unit economics, claiming that stores achieved profitability within months of opening, a timeline that seemed almost miraculous compared to traditional coffee shop economics, but was readily accepted by investors hungry for exposure to Chinese consumer growth. Post-IPO, Luckin's stock price continued climbing as the company reported quarter after quarter of spectacular growth, with revenue increasing by over 600% year over year in some reporting periods, figures that were largely fabricated but generated enormous paper profits for early investors and company insiders. The beginning of the end for Luckin's fraudulent empire came from an unlikely source, a short seller research report that meticulously documented discrepancies between the company's reported performance and observable reality on the ground. Muddy Waters Research, led by veteran short seller Carson Block, published a damning 89-page report in January 2020 that accused Luckin of fabricating sales and inflating key operating metrics. The report was based on extensive fieldwork conducted by investigators who spent months monitoring Luckin stores across China, counting actual customers, tracking delivery patterns, and analyzing the company's mobile app data to identify suspicious transaction patterns. Muddy Waters researchers discovered that many Luckin locations had far fewer customers than would be necessary to support the company's reported sales figures, with some stores appearing almost empty during peak hours, while still reporting strong revenue growth. The short seller report also identified technical anomalies in Luckin's mobile app, including unusual spikes in order volume that occurred outside normal business hours and didn't correspond to observable customer activity at physical store locations. Most damaging were the report's findings about Luckin's advertising partnerships, which revealed that several claimed marketing campaigns either never existed or involved significantly smaller expenditures than reported to investors. The research firm's allegations sent Luckin's stock price plummeting and triggered investigations by both Chinese securities regulators and the Securities and Exchange Commission, marking the beginning of a forensic accounting process that would ultimately expose the full scope of the company's fraudulent activities. As investigations intensified throughout early 2020, the carefully constructed walls of Luckin's fraudulent empire began crumbling under scrutiny from multiple regulatory agencies and independent auditors. The company initially denied all allegations of wrongdoing, claiming that short sellers were spreading false information to profit from declining share prices, a defense strategy that bought precious time but ultimately proved futile as evidence mounted. Luckin's board of directors, facing increasing pressure from investors and regulators, authorized an internal investigation led by independent legal counsel and forensic accountants who were granted broad access to company records and personnel. This internal probe, conducted by Kirkland & Ellis and FTI Consulting, quickly uncovered evidence of systematic fraud that was far more extensive than even the short sellers had alleged. Investigators discovered that fabricated transactions began as early as the second quarter of 2019 and continued through the fourth quarter, involving not just phantom coffee sales, but also fictitious partnerships, inflated marketing expenditures, and manipulated store performance data. The investigation revealed that Chief Operating Officer Jenny Qian had directed subordinates to create fake sales totaling approximately $310 million, representing roughly 40% of Luckin's reported revenue during the affected periods. Perhaps most shocking was the discovery that the fraud involved forged bank statements, fake supplier invoices, and manipulated point-of-sale system data, indicating a level of sophistication that suggested careful planning and coordination across multiple departments within the organization. The collapse of Luckin Coffee sent shockwaves through both Chinese and international financial markets, highlighting the risks associated with investing in rapidly growing Chinese companies that had limited operating histories and weak corporate governance structures. In April 2020, just months after denying all wrongdoing, Luckin's management was forced to announce that an internal investigation had discovered fabricated sales transactions totaling over $310 million, confirming the allegations made by short sellers and triggering one of the largest single-day stock declines in NASDAQ history. The company's shares, which had traded as high as $51 during their peak, plummeted to under $2 as investors rushed to exit their positions, and institutional shareholders filed class action lawsuits seeking billions in damages. Trading in Luckin's stock was suspended by NASDAQ, and the exchange began proceedings to delist the company for failing to meet minimum corporate governance standards and providing false financial information to investors. Chief Operating Officer Jenny Qian, Chief Marketing Officer Jian Liu, and several other senior executives were terminated immediately while CEO Jenny Jia Qian was placed on administrative leave pending further investigation. The Securities and Exchange Commission launched a formal investigation into Luckin's financial reporting practices and began coordinating with Chinese regulators to identify additional evidence of securities fraud. Beyond the immediate financial impact, Luckin's collapse raised serious questions about the effectiveness of auditing practices for Chinese companies listed on American exchanges and prompted calls for enhanced oversight of foreign corporate issuers who access U.S. capital markets. The aftermath of Luckin's collapse revealed the human cost of corporate fraud, affecting thousands of employees, franchisees, and small investors who had believed in the company's mission and growth potential. Over 30,000 Luckin employees faced uncertain futures as the company struggled to continue operations while managing multiple investigations and lawsuits, with many stores closing permanently and others operating under severe financial constraints. Chinese consumers who had embraced Luckin as a domestic alternative to foreign coffee chains expressed feelings of betrayal and disappointment, undermining trust in other emerging Chinese brands seeking to compete with established international competitors. The fraud's exposure also damaged China's reputation in international capital markets, contributing to increased scrutiny of Chinese companies seeking overseas investment and reinforcing stereotypes about corporate governance standards in emerging markets. Pension funds, university endowments, and individual retirement accounts that had invested in Luckin suffered massive losses, with total investor damages estimated to exceed $5 billion when accounting for the company's peak market capitalization. In July 2020, the Securities and Exchange Commission announced that Luckin had agreed to pay a $180 million penalty to settle charges related to its fraudulent financial reporting, one of the largest fines ever imposed on a Chinese company for securities violations. Jenny Qian and other key conspirators faced additional personal penalties and were permanently barred from serving as officers or directors of public companies, though criminal prosecutions remained limited due to jurisdictional challenges and diplomatic tensions between the United States and China. The Luckin Coffee scandal serves as a sobering reminder of how sophisticated financial fraud can flourish even in an era of enhanced regulatory oversight and advanced auditing technologies, particularly when perpetrators understand exactly how to exploit gaps in cross-border enforcement and investor psychology. The case exposed fundamental weaknesses in the due diligence processes used by investment banks, auditing firms, and institutional investors when evaluating rapidly growing companies in emerging markets, highlighting the need for more robust verification procedures and skeptical analysis of financial claims that seem too good to be true. Luckin's fraud also demonstrated how modern technology, rather than preventing corporate misconduct, can actually enable more sophisticated deception when criminals use mobile apps, digital payment systems, and automated reporting tools to create convincing but entirely fictitious business activity. The scandal contributed to broader regulatory reforms affecting Chinese companies listed on American exchanges, including enhanced disclosure requirements, mandatory auditing by firms subject to U.S. oversight, and increased penalties for companies that fail to meet corporate governance standards. Perhaps most importantly, the Luckin case illustrates how the pressure to achieve unrealistic growth targets in competitive markets can create perverse incentives that lead management teams to choose fraud over admitting failure, a dynamic that continues to threaten investor confidence across multiple industries and geographic regions. As global capital markets become increasingly interconnected and complex, the lessons learned from Luckin's spectacular rise and fall remain relevant for investors, regulators, and corporate leaders seeking to prevent similar frauds from devastating financial markets and betraying the trust of millions of stakeholders who depend on accurate financial reporting to make informed investment decisions.